From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, September 5th, 2025. Let's see what's happening around Milwaukee. The Brewers are back in town for games with St. Louis and Los Angeles. The fests are winding down, but you still have Tosa Fest this weekend on dry land in Wauwatosa. The International Kite Fest is happening at the lakefront. And one more, Make-A-Wish Foundation is holding their annual Walk for Wishes on Sunday morning at the Summerfest grounds. Okay, let's get started. The Finland Air Force just announced it will stop using the swastika on its flags. They conceded that it was often viewed as a symbol of Nazis. Oh, do you think? And now we're off to Kenya, where a Spanish tourist was posting his bad behavior on social media. So what did he do? He was intent on getting an elephant drunk. So he poured multiple 16-ounce beers down Dumbo's trunk. A spokesman for the wildlife sanctuary was outraged at the incident, although Dumbo didn't seem to mind. And I'm guessing he was happy someone opened the cans of beer for him. In Namibia, Africa, one of the country's top attractions, the Big Daddy Dunes National Park, well, the authorities there have condemned a group of tourists who posed naked atop the dunes and posted their nude photos and videos on the internet. So far, there have been no arrests. But we do believe they're Americans. Why? Because it sounds like something we do. On the podcast today, we have Tom Pappenfus, Joel Driesing, and with a look at the week, here's Kyle Tetting.
Well, I guess thanks, Max. Good week for a couple of the indexes. Down week for the Dow. I guess a bit of a mixed bag. The NASDAQ up 1.1%, closing at the end on Friday at 21,700. The S&P 500 up 0.3%, closing at 6482. And the Dow Jones Industrial Average down 144 points after a tough day on Friday, losing 220 on the day, down 0.3 for the week. For the year, Dow up 7.7, including dividends. The S&P up 11%, and the NASDAQ up 12.9. Joel, hard not to, in what was a short trading week with the holiday, hard not to start with the economic data and specifically labor market. We got a lot of news this week, I think, pointing to more of the same, despite some maybe new people in charge at the Bureau of Labor Statistics. The data really hasn't shifted all that much.
It may be supporting the notion that it doesn't matter who's the chief of the Bureau of Labor Statistics, that the numbers are the numbers. And the numbers didn't look all that encouraging for the employment aspects of our economy. It actually showed, every month they revised the two previous months' numbers, and it actually showed that in June, on a net basis, employers lost jobs for the first time since December of 2020. So we had a streak of more than 4 years of employers adding jobs every month, and that ended in June. But there are other numbers in there that suggest that it's getting harder to keep the momentum going as far as employment is concerned. And employment is important because we always point out that consumer spending is what drives our economy. And if employment is weak, then people aren't going to feel encouraged enough to keep spending.
And Tom, you were talking to me earlier today about perhaps one of the things that's helped economic growth a little more is that it hasn't strictly been consumer spending. We're seeing some spending in other areas maybe supporting that GDP number. Yeah,
absolutely. I mean, this is one of those statistics that can be seen in almost two different lights. It's and I'm referring to the artificial intelligence kind of boom and wave of spending that we've seen. Obviously, it's benefited stock markets, it's benefited all of our portfolios, but specifically to what you're referring to, Kyle, is that a predominant amount of the GDP growth we've seen since this has kind of started over the last year or two it's equating to about 35 to 45% of the GDP growth. And that if you were to strip that away, they estimate that GDP growth might be in the range of 1%. We might be closer to that I guess a much slower growth number that we were kind of expecting. So again, kind of back to the point of why does this matter? It's just that we are a consumer-driven economy, and you really are hopeful that the strength of our economy is kind of a reflection of how we're all doing and how our ability to spend, to earn money and grow. That the worrisome part about this is that it could mean that maybe this glut of spending coming from these large tech companies might be masking some more weaknesses that we can't quite see, that isn't showing up in the data. So it's one of those things that's great, and I don't think it's going to end anytime soon, but you also have to be mindful and look a little bit deeper.
Tom, I saw a New York Times story earlier this week estimating that globally it's going to be $375 billion in artificial intelligence investments this year alone, and up to $500 billion next year. And that's just what they can count. That's not even looking beyond some of the obvious ramifications of that. And as you and I discussed, those are investments. So you don't necessarily know how they're going to pay off. So it may be boosting the gross domestic product, the GDP, our economy now, but you don't know how they're going to pay off later. And to the degree that they're investments in productivity, then that helps the consumer aspect, and it helps the stockholder aspect, because if companies are more productive, they can have fewer people with greater output, and they can make a higher profit, and the people who are working can participate in that too. We had numbers this week that they were updating the productivity numbers for the second quarter of this year, and it was more productive than the initial estimates. And so far, since the end of 2019, we've been more productive on an annual basis than we were in the previous business cycle. We're still behind what we've been on average since World War II, but that productivity means something.
Well, and I think you talk about the investment and our ability to measure that investment in artificial intelligence, and I think it's a bigger conversation than just AI, certainly, but there are so many businesses that you wouldn't even on their surface think are involved in that kind of spending, but which ultimately money they're seeing come into their pockets as revenue, as ultimately hopefully earnings for shareholders, is directly tied to that type of investment. And I'm thinking of the utility companies and the companies that service the power lines themselves, and all of that is done to continue to provide for the growth that is necessary, going all the way down to the copper miners, right? Of we need more copper to be able to lay those lines. And so I think, it is woefully understated how significant that investment is. The challenge, of course, is if that we weren't investing in that, we might be investing somewhere else. And so as investors, what we want is for our capital, our commitment to these businesses we invest in, to be going towards the areas that are most productive, right? And if we are stimulating that productivity growth, that productivity spend, then ultimately it drives economic growth. And it also drives growth in our portfolios, which, Tom, I think we have seen in spades in some of the stocks that have done well.
Yeah, absolutely. It's, this has been an interesting year in kind of the waves of how this market has cycled back and forth. If you look at the first 6 months of this year, very defensive and value heavy, as far as performance is concerned. But I think probably since July, maybe late June, you've really started to see that once some of the uncertainty started to wane a little bit, people started to move more into a quote-unquote risk-on feeling. That would tend to lead towards more aggressive investments naturally in growth and technology. So definitely, that continues to be an area of strength in this market. It continues to attract the most dollars. It is supported again by earnings growth, as Bob would always say, one of the main and primary drivers of long-term performance. So yeah, it's artificial intelligence isn't going away, and I think to kind of the point you made, Joel, before, and Kyle, you elaborated on, is just this is part of, you call it our revolution, right? It's one of these revolutions that's out there that it's not. We highlight that, well, consumers aren't spending, but they're buying end products. This is investments and spending into components that drive greater productivity growth, greater property, plant, and equipment, and more efficiencies. And so I think that leads to more growth down the road in our environment.
And in theory, it's more stable spending from those individuals who are counting more in their portfolio, because that spend has translated to returns. Those returns then give our growing ranks of retirees in our country more confidence that they can continue to spend into retirement in ways that they were while they were working. And so, I've talked at length about the kind of transition from the largest portion of our, and often most productive portion of our workforce, from those final few working years into a retirement, and how that kind of provides a backdrop for spending that we haven't seen in our history, because we've never seen this significant of a portion of our population enter retirement. And so I think it all kind of translates to, it can be some slower periods of spend, it can be some weaker jobs data, but there are some signs, at least if we look out a little bit beyond just the current uncertainty, that there's positive stuff happening.
And Cal, as you and I discussed before, getting back to the jobs numbers, that again, the longer term concern is how the slower growth in job creation affects us later on, whether younger people, for instance, are finding work and getting into the workforce and gaining the skills and the experience that will make them the productive retirees that we have, coming out of the workforce now. And just a few of the numbers this week that kind of struck me is we had numbers on job openings. And for the first time since April of 2021, we had more job seekers than we had openings. And that's a rough estimate as to supply and demand. And so that was a little tilt there. And again, a lot of these numbers get revised, so that might be changed, but it's showing a trend there. In the numbers that came out today from the Bureau of Labor Statistics, we had the unemployment rate and the U6 rate, which measures sort of underemployment. Those were the highest that they've been since October of 2021, so almost 4 years. The number of jobs, and in its report itself, the government said that jobs basically have been stagnant since April, that there hasn't been much job growth since April. And since April, we've added about 27,000 jobs a month. So if you look on average, since the numbers started getting collected in 1947, it's been 124,000 a month. So you think of all the recessions and job losses that have happened between now and 1947. That's still a pretty big number. But again, it was also a growing population. Our population isn't growing as much. So again, it gets back to sort of a slower growth rate for the jobs, and hoping that technology, AI, and other things included can make them productive, so that the few jobs that are being created are rewarding.
Yeah, and I think we should be clear that there is some softer economic data. There's some more pessimistic views on where this might lead, and I think it's pretty early in some of this developing to really put too fine of a point on it. But we've always talked about direction. We've always talked about trend and how important it is to kind of monitor the way things are shifting. And I think clearly we are seeing signs across the board that things are softening, that we need to be paying more attention. And I think it was clear with kind of the market's expectations for the Fed that they think the Fed is going to pay more attention to this jobs data than what they had before. And we saw kind of the market for interest rates soften quite a bit. Tom, the Fed Watch tool from the Chicago Board of Trade now looking at potentially not just one cut in the September meeting, but maybe 2 quarter-point cut. And I think that's a big step towards maybe the Fed is finally starting to rethink, okay, it isn't strictly inflation anymore. Now we have to pay attention to the jobs data as well.
Yeah, I think it's futures markets are fully pricing in. I mean, with almost certainty that I think quarter-point cut happens now, and I think that the jobs numbers kind of reinforce that. Again, a quarter-point by the end of the year, second quarter-point by the end of the year, and then likely what I'm reading right now is maybe 3% terminal value by the end of next year. So I don't know if that's about 4 more cuts next year. So pretty steady, consistent pattern of cuts. Again, I think that all, as they say, will be data dependent. If we continue to slow and show some of these continued signs of weakening labor markets, I think the Fed will continue to look that way. And the other part you and I kind of talked about, Kyle, is just we continue to be in an environment of mixed data. We do have this weakening data on the labor side affecting, as a look at our economy. But you're looking at earnings as well and U.S. companies, and they're still quite resilient and strong. We're seeing revisions to the positive side again, and quite a large and substantial amount, much more than to the negative side. So again, we're getting kind of pulled in two different directions. Are we worried about weakening, or are we pretty content and confident in the way at least companies are doing? And maybe, Joel, as you I talked before, is that, well, maybe just the uncertainty is keeping them from hiring now to kind of see how this uncertainty plays out. That, if they continue to sell the same amount of goods, and as we've seen with consumer purchasing and retail sales numbers, that the consumer seems to be buying, it hasn't really slowed up too much, that things aren't doing too bad.
And Tom, to be fair, we're talking about weakening. We're not talking about weak. The economy is still pretty strong. That unemployment rate, even though it's the highest in 4 years, it's 4.3%, which is relatively low, historically speaking. And yeah, I think we're seeing more data that suggests that employers aren't as eager to hire, but they're also not eager to let people go. So a lot of what they're losing is attrition, is people retiring that they're not replacing.
I think a couple of other pieces in the economic data this week, Joel, that I look at, the ISM numbers are, while on their surface, not all that big of a headline. Some of the underlying kind of indicators that come from it, expectations for GDP growth that kind of get buried in those numbers, I think point to exactly what we're talking about, an economy that is still growing, just maybe not as fast as we might otherwise hope.
Yeah, those are based on surveys with supply managers and in both manufacturing and in the services industry. A lot of those surveys are coming back saying, hey, I don't know what to do. You tell me where tariffs are going to be and give me some certainty, and I can sort of plan things out and have a better feel for where things are going. So there's some of that. Both are kind of weak numbers for the services industry. There's growth there for the third month in a row, but it's near contraction. It's only barely expanding. For the manufacturing sector, they contracted for the sixth month in a row. And back to the hiring aspect, both of those are looking at months and months of contraction as far as hiring. And both of those, as he suggested, Kyle, based on their historic relationship with GDP growth, both of those are saying that it looks like the economy is growing about at a 1% annual rate right now.
It would add in the labor market data just a little bit of a look ahead. We've got some pretty significant disruption coming in the labor market data in this next month with all the government workers that are going to be potentially looking for new work. And so maybe, Joel, just give us a minute on kind of what we might see as some of those workers make their way off the government payroll here in this next month.
Sure, we've lost 97,000 federal workers since January. And just to put it in another aspect is I looked at the percentage of the total employment picture that federal government workers represent. It's now down to 1.83%, which hasn't gone down much in the last year or 5 years or 10 years, but it's the lowest percentage that it's ever been since 1947, since this data was first collected. So that may be significant. But to your point, Kyle, next month in October, we'll be getting numbers on September employment, and that's going to be showing probably a lot more federal government jobs lost, because a lot of people who took severance or are on paid leave through the DOGE program earlier this year, a lot of those people are on the payrolls right now, and they won't be next month.
I knew I could get you to reference Doge on the podcast.
You're welcome.
Thank you. I think just given all that's going on in kind of the labor market, that's more than enough for kind of a week of conversation. There's plenty of other stuff out there. But for now, we enjoy doing the show for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.